Welcome back to AlphaBot, where we break down automated trading ideas for MetaTrader 5, one strategy at a time. I'm your host here at AlphaBot, and in today's session we're exploring an expert advisor called the Detrended Fluctuation Regime Shift. This strategy borrows a tool from econophysics, Detrended Fluctuation Analysis, to judge whether a market genuinely has memory or is simply wandering at random. By the end of this video, you'll understand how it detects that shift, how it decides to go long or short, and how it manages risk. Remember, everything here is educational information only. Let's dive in. So what does this expert advisor actually do? At its heart, the Detrended Fluctuation Regime Shift is a trend-following system, but the engine that decides when to act is unusual. Instead of a moving average or a classic oscillator, it runs Detrended Fluctuation Analysis on the recent stream of returns. That analysis boils the market's behavior down to a single number, a scaling exponent that traders often call alpha. Here's the intuition. When alpha sits near 1/2, the series is behaving like a random walk, with no structure worth trading. When alpha climbs above 1/2, the series is described as persistent, meaning up moves tend to be followed by up moves and down moves by down moves. That persistence is where real trend memory lives. When alpha falls below 1/2, the series is anti-persistent, which tends to look choppy and mean reverting. What makes Detrended Fluctuation Analysis special is right there in the name. Before it measures the fluctuation inside each subwindow, it fits and removes a local straight-line trend. That detrending step is why the method is far less fooled by a drifting, non-stationary market, which is exactly the condition foreign exchange and index markets tend to live in. This particular expert advisor is designed to run on a single time frame, whatever you attach it to, and the notes suggest it's most at home on trending, liquid markets around the 30-minute to 1-hour range. It's direction agnostic, meaning it can take both long and short positions, and it only ever holds one position at a time, tagged with a magic number. In terms of who this style suits, it's aimed at traders who are curious about quantitative, regime-based thinking rather than simple indicator crossovers. Every element, from the entry gate to the exits, is engineered to keep losing trades small. As always, this is a framework for learning how such logic is built, not a recommendation, and trading always carries the risk of loss. Let's walk through the mechanics step by step. On every closed bar, the strategy rebuilds the scaling exponent, alpha, from the most recent block of log returns. By default, that window, called DfaWindow, is 128 bars. It integrates the mean-subtracted returns into a running profile, slices that profile across several geometrically spaced window sizes, detrends each slice, and measures how the fluctuation grows with scale. The slope of that relationship, on a log-log basis, is alpha. Now for the entry. The strategy does not trade simply because alpha is high. It waits for a fresh cross, the exact bar where alpha moves up through the arm level called AlphaTrend, which defaults to 0.55. That crossing moment is when the market's memory is described as switching on. Requiring a fresh cross, rather than just a high reading, keeps the expert advisor from piling in late into a regime that's already mature. Once that gate opens, the strategy needs a direction, and it takes that from the market's existing lean. First, it measures drift, the net change in the close over the last drift bars, which defaults to 20. Second, it checks structure, comparing the latest close to a slow trend EMA, by default a 50-period average. For a long, drift must be positive, and the close must sit above the trend EMA. For a short, drift must be negative, and the close must sit below the trend EMA. So the direction-agnostic gate is confirmed by two directional filters that must agree. On to risk. When a long is opened, the stop-loss is placed a distance of stop-ATR multiple times the current ATR below the entry, 1.5 times ATR by default. The take-profit is set at reward-risk multiples of that risk, defaulting to 2 times. A short mirrors this with the stop above and the target below. Position management runs on every tick. Once the trade moves break-even R risk multiples and profit, the stop is pulled up to the entry price, locking in break-even, and from there an ATR trail follows the price, but only ever tightens. Finally, there's the regime loss exit. If alpha falls back below AlphaExit, by default 0.50, the market's memory is considered gone and the position is closed immediately. That last rule is the main tool the strategy uses to keep losers small and drawdown shallow. Only one position is held at any time. Let's read through the core of the meta editor code on screen. At the top are the inputs you can adjust in the strategy tester. DfaWindow is the number of returns fed into the analysis, defaulting to 128. AlphaTrend is the level whose upcross arms an entry, and AlphaExit is the level that closes a trade when memory is lost. Trend EMA period, drift bars, and ATR period define the confirmation and volatility tools, while stop ATR multiple and reward risk shape the stop distance and the take-profit ratio. Now the entry gate. The Boolean called fresh cross is true only when the previous alpha was at or below AlphaTrend and the current alpha is above it. That's the exact moment of the upcross, not just any high reading. Below that, the code sets two direction flags. Go long is true when drift is positive and the last close is above the trend EMA. Go short is true when drift is negative and the last close is below the trend EMA. Look at the long block. Entry is taken at the ask. The stop loss is the entry minus stop ATR multiple times ATR. Risk is that distance. And the take profit is the entry plus reward risk times the risk. Then trade.by sends the order. The short block is the mirror image. Entry is the bid. The stop sits above at entry plus the ATR distance. And the take profit is placed below at reward risk times the risk before trade.sell is called. Same structure, opposite side. Let's bring this to life on the chart. Up top, we have the price candles with the blue trend EMA weaving through them. In the panel below is the star of the show, the DFA exponent alpha, plotted as a gold line. Two dashed levels sit on that panel. The upper one, at 0.55, is AlphaTrend, the arm level. The lower one, at 0.50, is AlphaExit, the regime loss level. Above the arm level is the trend memory zone, and below the exit level is the random, mean reverting zone. Watch the first few candles. Price drifts sideways in a quiet consolidation, and down in the panel alpha is loitering near 0.5, inside the random zone. The market has no memory worth trading here, so the strategy stands aside and simply keeps recomputing the exponent bar by bar. Now look at the fourth candle. Alpha lifts off and crosses up cleanly through the 0.55 arm level. That's the fresh cross the code demands. The moment memory is described as switching on. But the gate is direction agnostic, so the strategy checks the lean. Price is sitting above the blue trend EMA, and the drift over the last 20 bars is positive. Both directional filters agree on up, so the buy entry marker prints. The stop loss is placed a multiple of ATR below the entry, and the take profit is set at 2 times that risk, following the reward to risk default. From there, the next few candles push higher with real conviction. As price advances, the management logic pulls the stop up to break even once the trade is one risk multiple in front, and then an ATR trail follows behind, only ever tightening. Price reaches the take profit target, and the long is booked as a win in this illustration. Now the character changes. Price rolls over, and in the panel alpha fades, slipping back below the 0.50 exit level. Had a position still been open, that regime loss rule would have closed it right there. Price then breaks down through the trend EMA, so the blue line now sits above the candles. Watch the 10th candle. Alpha turns and crosses up through the 0.55 arm level once more. Memory is switching on again, but this time the lean is inverted. Drift over the last 20 bars is negative and the close is below the trend EMA, so both filters point down. The sell entry marker prints. Now the stop loss sits above the entry and the take profit is placed below at 2 times the risk. The following candles slide lower, the trail tightens behind the move, and price runs into the downside take profit target. The short is booked. On the final candle, alpha eases back toward the arm level without a fresh cross, so the strategy simply waits for the next genuine regime shift. That's the full cycle, memory off, memory on, join the lean, and manage the exit. And that's the Detrended Fluctuation Regime Shift Expert Advisor. We saw how it uses Detrended Fluctuation Analysis to measure the market's memory through the alpha exponent, how it waits for a fresh cross up through the arm level before joining the existing drift and structure, and how it protects each position with an ATR stop, a reward to risk target, a break-even lock, a trailing stop, and a regime loss exit. Everything we covered today is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and share your thoughts in the comments. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.